I think we'll have a few people still coming in, but I'm trying to stick to schedules. So, with that, I'm going to turn it over to a very good friend of mine who I worked with as a colleague at Freddie Mac, Professor Alan Marcus of Boston College. Alan, it's all yours.
Thank you, Ed. Well, you might be wondering how these three papers, one on flood insurance, one on Social Security, and one on central bank bailouts, all managed to find their way into one paper session. It was not an obvious fit. But I think that there is, in a way, a good message in the madness, which is that government contingent claims are ubiquitous, and once you start looking for them, you just find them everywhere. So in a sense, that's the meta lesson of these three papers. The other common themes that I think these papers bring to the forefront are two. One is the point that Debbie has been very vocal and very forceful about, which is that many, if not most of these government contingent claims are off budget. They're not particularly transparent. The valuation of these guarantees doesn't show up anywhere on the government deficit accounting. And it's really worth thinking about trying to put a value ex ante on these programs. The other thing that I think is kind of common to all these three papers is that it highlights that the way these implicit options are designed really matters a lot, partially for valuation, but also because it gives rise to very substantial and significant welfare and efficiency impacts. And in different ways, I think we'll see a lot of these themes coming through in all three of these papers. So having said that, I'm just going to turn the mic over to Jeremy.
Okay, well, thanks, Alan. Thanks very much, and thanks to the organizers for having this paper. As Alan said, the fit is it's a liberal interpretation to put me on the program. So thank you. So this is a joint project with Gita Gopinath, who's the deputy managing director of the IMF, and two of her IMF colleagues, Mitali Das and Taehoon Kim. And it's part of sort of a broader set of work that Gita and I got started on, trying to understand or try to think about the role of the dollar as a dominant international currency. And if you think about the role of the dollar kind of in the global financial system, there's at least four aspects that make it stand out. One is the dollar is overwhelmingly used as the unit of account in invoicing. So something like 60% of international trade is invoiced in dollars. So that's one thing. Second, there's a huge dollar banking system outside the United States. I mean, it's stunning. It's like roughly the size of our domestic banking system is the amount of deposits, dollar deposits in non-US banks. Third, and very closely related, those guys make a lot of dollar loans, and they often shove those dollar loans down the throats of borrowers who really should be borrowing in local currency instead, creating a mismatch, basically. So a lot of corporate borrowers are borrowing in dollars even when they don't have dollar revenues, and get into trouble when the dollar appreciates against the local currency. Fourth, and we're going to argue related, central banks in these countries hold an awful lot of dollar reserves. So this paper is really about understanding the last, but by connecting it to the previous two, to the dollar banking system and to mismatch. So let me just start with a few little facts here, just to kind of motivate. So yeah, foreign central banks roughly hold about $7 trillion in reserves. Of that, 4 trillion is literally in treasuries. A lot of the rest is in agencies and other forms of dollar debt. The dollar is the dominant form, so they hold others, but roughly 60% of all global foreign exchange reserves are held in dollars. When we had the dash for cash in March 2020, where there was all the turmoil in the treasury market, among the very big sellers of dollar denominated bonds were foreign central banks. So, you might say kind of casually, they seem to be big players both in the level of interest rates and sometimes at least in kind of volatility in interest rates. So why are these foreign central banks holding so much in the way of dollars. There are different motives and different, and I think the story is not uniform. I think it's different for different. There are trade-related motives. The one we want to focus on, and I'll try to show you a little evidence to support the idea that it's at least something, is that in many of these countries, as I said, the non-financial corporate sector is running a big mismatch, is sort of exposed. The banks have basically lent a lot in dollars, and a lot of these firms are going to get hurt when the dollar appreciates. And so there's the risk to the economy as a whole and to the banking system that when the dollar appreciates, there's going to be the need for some kind of intervention by the government, some sort of bailout, and it's useful to have dollars in those dollar appreciated states of the world. So in some sense, the central bank is planning to be a lender of last resort given the mismatch. Okay, so the paper basically has two parts. There's sort of a positive economics part, which tries to say, you know, why would they do this given that they could also just regulate more tightly? And essentially there's going to be a trade-off. You're going to want to do some capital regulation of the banks, but that has its own costs, and so you'll do some with reserve holdings. So that's sort of the positive. So if you left kind of each country to do their own thing, they'd do some bank regulation and they'd accumulate some reserves. So that's the first part of the paper. And the second thing, sort of a more normative thing, is that each country acting on its own, we're going to argue, is going to tend to overhoard reserves relative to what would happen is if you could imagine sort of a global planner doing the right thing. And the point is that these individual countries don't take into account that when they stockpile all these dollars, right? You've heard of the global savings glut. Well, they're, you know, like the magnitude suggests, they're pretty big contributors to that. Imagine two countries, right? Country one is saying, geez, I've got this problem. All the banks in my, banks in my country are making all these dollar loans. We have all these mismatched corporates, so I'm gonna accumulate dollars. Well, when everybody does that, that pushes down dollar interest rates and makes it all the more tempting for people to borrow in dollars. So my country A's decision to do all this stockpiling is creating an externality through the interest rate on country B, and we all end up kind of chasing our tail, having a lot of reserves, but having kind of suppressed dollar interest rates, okay, which then causes the mismatch. So the idea is a global, somebody who takes into account the interest rate effects would say, guys, why don't we do less of this with reserve holdings and more of this with regulation? Okay, so that's basically the point. All right, so I think I've kind of said this, that, you know, the basic idea is you have a small country, a central bank, may have a banking crisis, there may need to be a bailout. If that banking crisis occurs when there's a lot of mismatch, you'd like to have dollar reserves to deal with the fact that things are worse when the dollar appreciates. So, you know, you can either hold the reserves or you can do a bunch of taxation to bail out the system, but that's not great. So you're going to want to have the reserves. You could also have had more stringent regulation, make the banks hold more capital. Again, all these things have their costs, so you're going to settle on some amount of holding reserves. And then again, I've sort of previewed the externality that an individual country is going to kind of like holding the reserves because they're not taking into account that it sort of affects the interest rate, and then they don't have to be as tough on regulating their banks. All right, so there's some related work. I'm going to skip it. I'll show you a little bit of evidence, and let me just say this evidence is sketchy. And it is not only because of my limitations as an econometrician, which are many, it's also because the data is kind of sketchy. So for example, we want to relate dollar reserve holdings to some notion of mismatch at the country level. The first problem right out of the gate is many countries do not disclose. They all disclose their total foreign currency reserves. They're not obligated to publicly disclose the currency composition. So we were able to cobble it together for 53 countries, but that leaves a lot out, okay? And then we want to relate that to sort of their dollar-denominated borrowing of their non-financial corporate sector. Again, data is kind of sketchy, okay? So I'll show you some plots, and they're sort of consistent, but, you know, I would interpret this all very gingerly, okay? But just, you know, this at least is not inconsistent with the idea that worrying about the corporate sector is one of the motives surely not the only motive, but one of the motives that seems to be associated with central bank reserve holdings. So here's the first kind of dumbest picture you can do. This is data over 2013 to 20, have taken each country and averaged it over time. So each data point is a country's time averaged thing. Horizontal axis is the dollar-denominated bank borrowing of the non-financial corporate sector scaled to GDP, and the vertical axis is central bank dollar reserves, also scaled to GDP, and you can see there's some kind of relationship. So countries that have more dollar-denominated borrowing in the non-financial corporate sector seem to have, or do in the data, have more central banks holding reserves. So again, consistent with the motive that mismatch, that the threat of mismatch is one motive for this to happen. If you break this up a little bit, you probably can't see this, but just to sort of get a sense of where it lives, we broke it up into, in the top panel, advanced economies by the IMF's definition, middle panel, emerging markets, and lower panel, developing. These are the poorest economies. The result is there in the top two. It's a little more fragile for the advanced economies, really driven by a few data points, Hong Kong especially. It's sort of robust. It feels like, to the extent there's something there, it's most robust in emerging markets. And consistent with what people will tell you, and if you think about countries like Peru or Turkey or others like that, that's where you see a lot of this kind of mismatch in the corporate sector. All right, so that's kind of all I wanted to show you with data. So let me see if I can do this with zero algebra. I want to kind of tell you our theory, kind of tell you the idea with zero algebra, just kind of give you a sense of the setup. So as I said, we'll start with imagine a small country, where what I mean by small is they don't take into account their impact on dollar interest rates, and see what happens. So imagine there's just two dates, and you have households that can save in one of three forms. They can have home currency denominated deposits in their bank in home currency, dollar denominated deposits, or some risky thing which we can just call equity. Okay, and we're sort of just going to hardwire in here that there's a preference, all else equal, for dollar deposits. Okay, in our previous work, we endogenized that by saying you're buying a lot of goods that are invoiced in dollars, so it's nice to have a dollar bank account. Here, we're just saying there's a preference for having a dollar bank account, and that's going to give us essentially a lower interest rate in dollars, which is going to set the whole thing going. Okay, let's see. Then there are going to be banks, and when I say banks here, I've mushed together, for the purpose of the theory, I've mushed together the banks and the non-financial corporates to whom they're lending. Okay, so for the purpose of the model, it doesn't really matter. In the data, it's important that regulation basically tends to just very strongly discourage banks from having outright currency mismatch. So you don't see a lot of, I have dollar deposits and whatever non-dollar denominated loans. Instead, they look like they're matched superficially because they take the dollar deposits and they push them out as dollar loans so the mismatch lives much more on the balance sheets of the corporate sector. Of course, they have an indirect dollar exposure because their credit risk now is very tied to the dollar, right? So when the dollar appreciates, more guys go bust on them. But it won't look, so if you just literally measure assets and liabilities, they're extremely highly correlated for banks. It's dollar on dollar. So the mismatch lives in the corporate sector. But here I'm kind of abstracting from that and just kind of assuming it's all one thing. So you can have a bank. The bank is going to basically borrow in one of three ways. It's going to either have deposits, local denominated deposits, dollar denominated deposits, or it's going to raise equity. Okay, and the thing that kind of makes a problem for the government is there's some small probability that there's going to be a banking crisis, and some fraction, I'm making this super simple, some fraction of the banks are just like vaporized, and if they're vaporized, a la SVB and systemic risk exemption, the government is going to come in and have to bring some resources to make them whole. Okay, so what can the government do if it finds itself in this bad situation? Well, it can raise taxes to basically pay for the bailout, but I'm going to assume that that's costly, that they're distortionary costs, a way of saying, limited fiscal capacity, basically. They can raise the taxes, but it's painful to do. They could have also, ex ante, regulated the banks so that this was less likely to be a problem. But if there's not enough capital, then the alternative, the final third thing they can do is hold reserves. Okay, and that's on this thing. So what do you can think what the central bank or the government as a whole does is it issues local currency money and takes the proceeds or local currency bonds and takes the proceeds and acquires dollars. To the extent that interest rates on dollars are lower, that has a negative carry for the government. That's a real cost. It's basically transferring resources to the United States. Okay, so that's a cost. And what's good about it is if you hold dollars, you will have more wealth in the states of the world when the dollar has appreciated, which is exactly when you want it, because you're going to have to make good on all those appreciated dollar deposits. So it's a form of risk management. It's very much like corporate risk management, right? You want to hold something that is going to give you money in the states of the world where you can't raise external finance, or here where it's expensive for you to raise taxes, okay? So reserves are like a very nice hedge if you've got this sort of dollar liability. Okay, so that's basically what goes on. And then there's going to be kind of an interior optimum where, depending on how bad the negative carry is and how little you like to do capital regulation, you're going to do some mix of the two. Okay. Okay, so here's like just a little silly example. So if you look at the first column on the left, if there is no regulation, if there's no capital requirements whatsoever on the banks, these banks go for broke. They hold 0K, that's capital. And B dollar and BH is how much they borrow in dollars, dollar deposits, and local currency. So you'll see they'll do a lot of dollar borrowing because it's cheaper, no capital. And as a result, the central bank is like, whoa, I need to hold a lot of dollar reserves. That's the last row. Okay. Now, if you say, let's let them capital regulate, that's good. They'll make them hold like 7 or 8% capital in this example, and then they can get by with a little bit less in reserves. If you give the central bank very strong regulatory power, if you say not only can you set capital requirements, but you can set funding mix requirements. That is, you can say, not only do I want the banks to hold capital, but I don't want them making dollar-denominated loans. Right? If you can do that, that's very attractive here. And so you'll very strongly, if you look in the last column in the top row, B dollar drops very precipitously. If you can control it, you say, I don't want you guys doing this mismatch. You just outlaw it. And then you can get by with way less in dollar reserves. Okay, I put this last row up there as like a hypothetical. In other words, it's very hard to imagine, given that the mismatch lives in the corporate sector, it's very hard. Our regulatory tools don't really reach there well, but it's just to show you that when we get to the global thing, if you can't directly regulate funding mix, an indirect way to do it is with the interest rate. Right? This is a very familiar theme. When do you use interest rates? It's kind of a second best thing if you don't have very good regulation, right? If you have very good regulation, you just say, don't mismatch, right? If you have bad in a global context, what you do is something that makes dollar interest rates lower. Okay, so when I go to the global case, I'm going to say, realistically, you can't regulate the funding mix. You can regulate capital, but you have this extra tool, which is you can kind of coordinate people on the level of reserves. Okay, and is that in some sense a second best way to go? Okay, so then the model is just basically put all these countries together. Okay, so there's the global economy is just a whole mess of these countries, and the only thing that differs is now the dollar interest rate is endogenized. So the more reserves basically that everybody is stockpiling, the scarcer are the dollars for everybody else, and so dollar interest rates are lower. Okay, that's the only difference. And now I'm going to ask, will a global, imagine sort of a global planner who takes that into account, what will their preferences for reserves be as opposed to the local. Okay, and so there's a bunch of different effects floating around here. I should say the model we've got in the paper is kind of a little bit of a mess because we imagined that this planner was acting on behalf of all the EMs and we left the US out. Okay, better thing to do is to put the US in because there's a bunch of transfers here basically going from the EMs and their sort of reserve carrying. So when you put that in, a bunch of stuff nets out more cleanly and it focuses you really on the last two things here. The real kind of economic externality when you net out all the transfers is the idea that the local guys don't take into account the effect of the interest rate on these mismatch incentives. Okay, I mean, I'm simplifying a little bit, but that's kind of the essence of it. So let me just run you one more example. So the left column is, again, imagine that there's no regulation or reserve holdings. Now let's go to a situation first where each country sets its own reserves and capital requirements, and then one where there's sort of a global planner acting collectively. And so what you can see in the second column is, in the last row, I'm sorry, top row, Q dollar is 1/1 plus the dollar interest rate. So in the first case, when there are no reserve holdings, that 9.55 is like 4.5% approximately. Okay, so there the dollar interest rate is like 4.5%. If you go to the case where you have this local central bank, you see in the last row, they accumulate a ton of reserves. And when every central bank is doing that, it very powerfully drives down the interest rate. So now the dollar interest rate goes from 4.5% to the 0.975 is roughly 2.5%. Okay, and what does that do? That dramatically increases the incentive of guys to mismatch. So the dollar borrowing goes from 25 to almost 60. Okay, right? So they're all kind of creating this mismatch problem for themselves, which is then part of the reason why they're holding all these reserves. Right, so it's kind of a little bit, self-frustrating. So if you let a global planner go at this, what do? They hold much less in the way of reserves, down to about 28. Instead, they go, well, let's deal with this problem with much more aggressive capital regulation. See, because that is well internalized. Everybody's like, I don't want to capital regulate because I'm being protective of my banks. There's no spillover there. The spillover is all with reserves. So they jack up reserves a lot. I mean, I'm sorry, they lower reserves quite a bit. As a result, interest rates come back up to roughly 3.5%. And as a result, the mismatch gets better. Okay, so that's kind of the basic mechanism in the model. You can sort of embellish this. How am I doing on time? Am I out of time? Oh, okay. You can embellish this. I had a situation where every country was experiencing a crisis at the same time, just to make it simple. If you imagine some countries are having, they're imperfectly correlated, then there's another motive for economizing, which is it's just like, why would and this is a little related to the LCR kind of stuff. You don't want to over immobilize safe assets. You can imagine if each company did its liquidity management on its own, it would stockpile a bunch of reserves or T-bills. Well, we have a bank that gives it a credit line, and then the bank stockpiles, but because they're not going to all need it at the same time, you don't immobilize quite as much. Same principle here. Instead of each country, you'd like to have some kind of supranational organization doing this. And in fact, the IMF does a little bit of this. They have essentially credit facilities that allow countries to draw. And presumably, if you're qualified for one of these things, the idea is because you can do that, you don't need to stockpile as many dollar reserves yourself because you can draw from the IMF. And so I think this kind of analysis is supportive of doing stuff like that. And in fact, the head of the IMF just gave a speech basically, I think you can interpret it as like maybe we should be doing a bit more, because right now these IMF facilities, I think you have to be a country in extremely good standing to qualify. And this analysis probably suggests, all else equal, doing a little bit more and making these things a little bit more accessible. It's a form of lender of last resort, I guess. But it's exactly the same idea. Now I'm actually seeing a connection to something. I think I'm making an argument that's very parallel to Bill, what you were saying, right? You were saying, why are we having all these banks sort of immobilize all these assets, right? And then, not even all that good in a crisis. That's why we need a central bank. Well, in some sense, these countries are very much the analog, right? They're stockpiling all this stuff for a crisis. And we're saying, wouldn't it be better if we economized on all that by having a stronger global lender of last resort function? I mean, obviously, it's harder to do. You could imagine the IMF like a strong version of this. Pierre-Olivier Gourinchas was floating this idea. You could have a strong version of this where everybody basically makes a deposit. They take their reserves and they give them to the IMF. The IMF gives them a deposit account. It, let's say, takes in, from 10 countries, 100 each. Now it has 1,000. But instead of investing it all in treasuries, they invest half in treasuries. They do some fractional reserving and the rest in global equities. And they act as a bank. The problem is they're going to need a backstop from the Fed, right? Because the IMF, unlike the Fed, doesn't create the elastic currency. But the question is, can you do a little bit more of something that looks like a global? So I'm starting to see much more that, it has a sort of global lender of last resort thing that would allow us to economize and thereby ease this sort of, dollar scarcity, which contributes to sort of dumb stuff like guys borrowing too much in dollars. So that's kind of where we are. Okay, don't have great ideas about the institutional thing. Wanted to start out just sort of, being clear about what the externality was, and then hopefully there'll be at some point some conversation about maybe how to advance this a little bit. Thanks.
So we can take questions. I'll start with one question. Yeah. One thing I don't understand about your tables is that I don't see when you look at the optimal level of dollar borrowings that the global central planner would dictate. I would have thought that since there's no obvious advantage to the global economy of any of this mismatch, that that maybe the optimal solution for the global planner would be $0 borrowing. So maybe I'm misinterpreting your table in terms of gross versus net. But my general question is, would the optimal regulatory response in your model be to force banks to have a zero mismatch between their operational exposure and their dollar borrowing?
Well, because there are, you can say this one of two ways. The banks make money by borrowing in dollars because it's cheaper. And that's a source of utility in some sense. So the reason it's cheaper is the household sector has some benefit from borrowing in dollars, maybe because of dollar invoicing, which is exogenous. So that's why you don't want to drive it to zero. You're doing some balancing of, yeah.
Okay, so I guess the follow-up then would be, have you thought at all about what would drive cross-sectional variation across countries in how much mismatch they're going to settle on?
So
in other words, you start with that graph.
You can do a lot of stuff about the cross section of how much reserves they have, right? So that'll have to do with their own sort of carrying cost spread and other things. Now, of course, there is a single dollar interest rate. Right? There's a single dollar equilibrium interest rate, so that will be common to everybody in terms of the corporate sector, right? So the only way you're going to get you'll get some variation. The thing that holds back individual corporates from borrowing dollars is they do, to some degree, recognize that this can get them into trouble. So if they're sort of, small firms versus large firms, and there is heterogeneity in the regulation. There are some countries where the banking regulators, I think Brazil is an example, where the banking regulators do a better job of looking through and saying, not only do you as a bank have to be kind of nominally matched, but we're going to count against you if you're lending to a corporate that's mismatched. So that should, in principle, the regulatory environment can drive something. We haven't looked at it.
Okay. From the audience?
How would the IMF getting a swap line from the Fed take care of this problem? So if, given that the Fed is the only one that can issue dollars, if they are willing to give a large swap line to the IMF, it would seem like the externality goes away.
So I've gotten the swap line question a lot of times. Let me do it in 2 steps. So let's imagine the first question that often comes up is, do Fed swap lines to countries, are they a substitute for reserves? And the answer is no. What reserves are doing here, the whole thing that reserves are doing here, it's a risk management device that transfers wealth across different states of the world. So when you hold these reserves ex ante, you're basically saying, I'm going to make a profit on them when the dollar appreciates. That's a state of the world where I want more wealth, because then paying off the dollar depositors is more expensive. Okay, so it transfers wealth from some states to others. The swap lines come in ex post and have to be paid off state by state. So the swap lines do not transfer wealth ex ante. You know, they're not an arrangement where basically you're going to have losses in some states and not losses in other states. Okay, so it solves a different problem. It's like, you know, the lender of last resort can't, if the lender of last resort has to break even state by state, they can't transfer wealth from one state to another. So this is sort of more like an insurance or risk. It's like holding derivatives, basically. This is like a derivative on the dollar. That's what its economic function is. You say, oh, I've got all this mismatch. I'm going to be really hurting in states of the world where the dollar is appreciated. That's why you hold more dollar reserves against dollar borrowing than against local currency borrowing, because it's a better hedge. So I think the swap lines are a different function. And I think if you then extend it, the same thing, I think you could imagine there would be states of the world where if the IMF does this fractional reserve banking, they're just kind of underwater in some states. So I don't know if a swap line that has to break even state by state, it would be helpful. I'm not sure if it's, I have not thought through the IMF version of it carefully enough, but there is at least this distinction.
Okay. We're almost out of time, but maybe we have time for one more question, if anybody wants to ask.
I mean, when you think about the derivatives position, you could think about a country buying, options to pay off when its currency depreciates, and that's what you're engineering a little bit. That does seem to then create sort of somewhat negative incentives for the country, since inflation and sort of depreciations are things they should be avoiding. Making those less painful can bring on sort of the sorts of problems that a lot of emerging markets get into, where they have big budget deficits and they're not, they don't suffer in the bad states of the world where they deliver bad governance as much.
Interesting. So, fair. Like in our model, the depreciation is totally exogenous.
One reason for fixed exchange rates, right, is the idea that you're committing yourself not to do bad things, and it needs to be painful when you screw up, kind of, or there's no commitment to that.
Yeah.
Okay, great. So is Suzanne online, or are we going to Pari next?
She's online.
Okay, so Suzanne's going to talk about Social Security and early claiming of benefits.
Thank you very much. And my thanks to Debbie for asking me to be part of this session, and also to Alan for creating that connective tissue, that meta lesson that that you pick up from these papers, because they do feel quite different. And if anything, we're going to take a bit of a jump from thinking about countries and central banks from a broad perspective down to a very individual level perspective in this next piece. And thank you also for to Debbie for letting me present online. I was unable to travel to Cambridge today, as much as I would have absolutely loved to be there. So this project is joint with my co-author, John Payne from Duke University. He's a management and psychology professor. I'm trained as more of a behavioral scientist, behavioral economist. And between the two of us, we've been looking at the question of decumulation and in particular, Social Security claiming. So to give you just a little bit of background and get everybody on the same page on what we're talking about with Social Security claiming in the US, most American workers have access to Social Security. It's part of a larger portfolio of opportunities that they have for what you could think of as what we call decumulation, how to draw down assets in an optimal way. The decumulation problem, as I'll discuss in a moment, is a very particularly sticky one. You see some of the behavior that Jeremy was talking about with the central banks in terms of some precautionary savings and holding out for sort of extreme events. At the same time, we see underinvestment in insurance products like annuities or things like reverse mortgages. And one of the things we see in Social Security is that people claim earlier than perhaps we might expect them to at a population average. So for example, if we look at data, this is from 2018 from the Social Security Administration on claiming age, the full retirement age for most Americans is around 66 to 67, depending on when they were born. And yet what we see is that the largest proportion of people claim at age 62 as soon as they are eligible, and they give up money to be able to do that. Now, that's not to say that that's not optimal for those individuals. They might have shorter life expectations or other things driving them. But if we assumed a normal distribution in life expectancies and looking at the policies of the Social Security Administration and how claiming rates are set, we'd expect a bit more of a sort of normal distribution in these claiming, and the rates claiming at each age. And instead, we see people very front loaded. And so that suggests that at least as a general population trend, people are claiming earlier than perhaps they should. Again, not necessarily at the individual level, but more as a population trend. All right, so again, the standard claiming age is somewhere around 66. And so the decumulation problem itself, the reason that it's so messy, and here's a quote by Richard Thaler and another by Bill Sharp, who call it one of the trickiest problems in finance. And to me, the reason that is that the normative solutions or the normative theories on what we would tell people to claim optimally are incredibly complex, because a lot of the uncertainty is at the individual level, especially around life expectations, but also things about medical costs, family responsibilities, beneficiaries, all sorts of things that people have a very hard time predicting. And so creating an optimal solution where we could go across the board and tell people the advice that we want to give on claiming is particularly hard. So the way that my co-author and I have come at this problem is to think about what the individual drivers of some of that decision-making is, and how do we understand what people are thinking about as they're working through the trade-offs of earlier versus later claiming and some of these other decumulation issues. And just to give you one more example, this is a cartoon that we love. This sort of the standard problem that a lot of households face. If we take a late retirement and an early death, we'll just squeak by. So how do you get the resources to last for something that's a pretty uncertain time span that can be as short as 5 or 10 years and as long as 30 years? And sometimes I point out that a lot of American workers are facing a world where they've maybe been in the workforce for about 30 years, and then they have another 30 years that they need to get through retirement. And so trying to balance the resources to last that long is difficult. Okay, so the goals of our project, we were very interested in individual differences, and especially some of the psychological differences that might help influence people on this decision. And we're looking at our DV is intentions to claim Social Security benefits. So we are not tracking actual claiming behavior, partly because that would take a much more longitudinal approach to be able to track people over time in terms of what their claiming is, but more intentions to claim. And data from HRS and other sources have suggested that the intentions to claim and actual claiming is actually pretty well correlated and still indicative of what people are actually going to do. So we're going to start with individual differences. We're also going to think about how can changes in the information that people see affect those intentions. And notice that part of what we're trying to do here is consistent with some of the concerns that Debbie had expressed in putting together this conference, thinking about how the valuation at the individual level might be affecting the claiming against this government resource. Now, one other thing I'll mention of the 4 individual differences that I'm going to talk about that you see here, life expectations and intertemporal patience, you would find those in perhaps in a typical life cycle model, right? That would take into account the fact of how long people have to go and how they're discounting those future outcomes. loss aversion and psychological ownership are going to be more purely psychological factors that we're going to introduce into thinking through this problem. So we ran a bunch of studies. I'll get to some of the data in a moment, but to just give you an idea of those 4 factors that we're talking about, for life expectations, we're treating it as subjective life expectations. Obviously, we don't know for our survey participants how long they actually are going to live. We're soliciting that from them. And one of the things we've learned in doing this research over time is that the way that we ask those questions actually has a really big effect on the type of life expectations people give us. So in other words, there's a bias that comes from the way that the question is asked. We've done research showing that if you ask in a live to frame, and so you see that on the screen, the chance I will live to 65 years old, and ask people to give us a probability, versus a die by frame, the same question, but posed as the probability you'll die before age 65, we would expect those to be complementary and to add to 100 if they were side by side. And yet, depending on which one of those 2 questions people see, they answer very differently. So this is from an earlier paper that we had done on this topic. And we find approximately a 10-year gap in typical life expectations according to which frame is asked. And so when I get to the results for Social Security claiming, we typically use live to frames, partly because they're a bit closer to the actuarial tables for older ages, which we think is more relevant for the Social Security claiming decision. But just an example of where the behavioral framing can really change the way people are thinking about this problem. Another thing we're asking that's more of a psychological measure is loss aversion, based on the Kahneman and Tversky prospect theory value function. And so we have a series of gamble questions like this one. And what we find is that this one has matched expected values. People tend to choose the gamble with the smaller loss associated with it, even as the expected value is the same. If we raise the expected value of gamble 2, and we look to see, at what point people switch over from choosing the lower expected value gamble to the higher expected value gamble, we can get some sort of a measure of what we can approximate their loss aversion coefficient as. And so we give a set of 10 questions that helps us figure that out. Another one that we've introduced here, and I think we're the first ones to look at this in the Social Security and claiming space, is what we call psychological ownership. And this is based on a theory from within consumer behavior that people can feel ownership even for things that are not legally theirs. And so in behavioral economics, we have a long history of the endowment effect. And even the endowment effect, which has mostly focused on legal ownership, we can trigger the endowment effect for things that people feel psychological ownership for, even if they don't have a legal claim to. And so the questions that we've devised here for Social Security claiming are about how much people feel like the money that the government is holding in terms of future benefits is actually their money. And I want to explicitly point out the second of the 3 questions shown on your screen. The Social Security benefits I will receive come from the money I contributed. That's not technically true. That is not how our Social Security system works in the US, which is uses the money contributed by current workers to pay current beneficiaries. And yet the fact that a lot of people agree strongly with that statement suggests that they are looking at the money that they've contributed into Social Security as being held almost like a 401k account that they're going to cash out once they retire. And the stronger those feelings are that that's my money that the government is sitting on, the sooner they're going to want their benefits, and you'll see that in a moment. And then the last measure that I'll show you is what we call intertemporal patience. Think of this as just an individual level discount factor for future outcomes. We assess it with a very simple 3-item scale that's been developed by some other economists, Shriver and Weber. All right, so putting this all together, the 4 studies that are put together for the data I'm about to show you in a moment, they're all run with Qualtrics panels. We focus on people in the 30 or 40 to 65-year-old range before they've claimed Social Security, because again, we're trying to measure intentions. And I'm not going to go through all the data here, but it's a pretty representative sample that we get from that panel. Okay, so here's the big takeaway slide. And what I want to focus on is the measures in the red box. All 4 of the psychological measures are significant for predicting claiming intentions. And there's, various ways that we've looked at this. I think the big takeaways here is that things like Social Security solvency, which is often explained in the literature as a reason for why people delay or don't delay Social Security claiming, they're worried that the Social Security Administration is going to run out of money, that the trust fund is going to go to zero, and they want their money before that happens. That does have an effect. You see the negative coefficient on SSA solvency towards the top of the table, but it turns out that some of the more psychological explanations are actually more powerful in explaining the people who want to claim earlier versus claim later. So the longer you expect to live, the later you're willing to claim. That's not necessarily a surprise to us. The more patient you are, the longer you're willing to wait to claim. That's not a surprise either. The more loss averse you are, the sooner you want to claim. And part of that is a feeling that if you don't live long enough, the government gets to keep some of your money, and that loss aversion is kicking in. And then psychological ownership, the more you feel like it's your money that the government has been sitting on, the sooner you want it back. And so that also has a really big effect on that claiming decision. So those psychological factors help improve the model in terms of being able to explain the differences we see in people's claiming behaviors. I think I'm running out of time, so I'll be very quick in terms of talking about interventions. Some of the additional testing we've been doing is on messaging and interventions and how to help people think through this decision. The Social Security Administration used for a long time something called the break-even chart, which you see here. This is Schwab's version of that chart. And this also gives you some idea of, how long, if people are thinking about their life expectations, how that might affect the claiming decision. So claiming at 62, if you think you won't live past about 80, that's that blue line, is a better financial outcome. But if you have life expectations past about 80, that green line starts to overtake it at that point. It turns out that showing people this break-even chart encourages them to claim earlier. They report earlier claiming intentions. And again, we think that's partly the feeling of loss aversion of, if something happens to me and I don't make it past 80, I don't want to have missed out on my benefits. So we've tried different things like this cumulative table that gives people some idea of, if you live to later ages, what the cumulative amounts are for claiming at different ages. And clearly the longer you expect to live, the higher the payout is for later claiming. And yet this information display does the same thing that the break-even table does, which is that people claim even earlier, report claiming even earlier, and you see that in these regression results in the lower rows. The payout table is moving people earlier, and the payout table crossed with people who have high loss, individual levels of loss aversion, pushes them even earlier. So it does seem like giving people that kind of information triggers that loss aversion among the individuals who are concerned about losses and pushes them sooner. So we've been also testing in other projects and custom interventions. I'm going to skip that in the interest of time. And just to summarize, I think our big takeaway is to really think at the individual level, how those individual differences are affecting intentions, to think about some of these emotional and psychological inputs as being important, so things like ownership and loss aversion. And I think going forward, we're trying to figure out how to do better on the information displays and the messaging to help people get better at the valuation of what these kinds of benefits should count as. And so I'll stop there and happy to take any questions. Thank you.
Well, thank you very much, Suzanne. I really like your results on the ownership effect, and it really made me think back to some conversations I had with my own parents when anytime there was a proposal that would even remotely threaten Social Security benefits, my father would get red in the face and tell me how he had paid into this and he'd be damned if they're going to steal his benefits away from him. What I want, and maybe this is unfair to AARP, but I always felt like he was reading a bunch of bullet points from some AARP political propaganda and just sort of having bought it hook, line, and sinker. So my question is, if you believe that the clientele of AARP are retired people, as their name suggests, and they're putting out all this political stuff to protect Social Security benefits, I wonder if inadvertently they aren't doing a disservice to their purported clientele by encouraging them, with that, maybe without realizing it, to be claiming systematically earlier than they really ought to be. And related question is, I wonder if the extent to which people are willing to buy that argument is also somehow related to their financial literacy or illiteracy. And I wonder if to what extent you would question whether some of your results are the psychological impact of this feeling of ownership, or is that feeling of ownership possibly a proxy for financial illiteracy, which also might encourage people to claim benefits early? So get your reactions.
A beautiful question. I love it. And to me, I do a lot of work on how psychological ownership influences financial decisions of all types. And in the claiming space, especially, to me, this is almost $1 million question. And note that it carries over to things like pensions and 401ks and things like that. Part of the almost precautionary savings that we see in 401ks, where people don't really pull the money out that fast once they've got some savings there. Some do and some don't, but the ones who don't, I think part of it is this feeling of almost the security of, I've got this big lump of money and it's mine and I don't want to be spending it. So there's many pieces wrapped up in that. So let me start with the policy side. I do think that, messaging from AARP and even from the government itself, if you go back in history to when FDR set up Social Security, he made a very conscious decision that it should be partly funded from worker contributions. And if you look at some of the quotes from why he did that, he was honestly thinking about something like ownership. And he was worried at the time that Social Security would get shut down as a program. And he thought by building this sense of ownership into it, it would keep the program alive. People would not allow it to ever go away. And so there's almost a political aspect to that's baked in. And I feel like AARP continues to sort of use that to drive some of the policy making around it. At the same time, I don't think that's necessarily a bad thing. I think it's a very good thing that people feel that way about it. But it does have this unintended consequence of pushing them to perhaps think about claiming earlier. And so one question is, can we do anything in the messaging or the interventions that help them think differently about that ownership piece? And I'll admit that's something I've struggled for almost 10 years now in trying to test different approaches. And we haven't found a good one that really releases that feeling of ownership. Now, you asked also about financial literacy. We have, and we often do, collect financial literacy in some of these studies. I didn't present that data here. It's not in the meta-analysis that we did because it's only in some studies that we've collected it. When we look at it relative to psychological ownership, there doesn't seem to be a correlation there. Neither does there seem to be a correlation between income and psychological ownership, or even their existing levels of retirement savings and psychological ownership. So it does seem that it's a psychologically distinct feeling that people have. In other research I've been doing on psychological ownership for financial decisions, what we're finding is that it truly is sort of an individual level difference. Some people feel much stronger ownership over their financial resources of all kinds. So debt, mortgages, savings, income, all of those sorts of things. Some folks just really feel like it's theirs and they want to protect it. And some people have a much more flexible and fungible perspective about money. And so it doesn't seem to be linked to literacy, to your question there, but I could go back and check that data. And I feel like I might have missed something else. There was a lot in that question,
Okay.
but a really, really good one. I loved it.
Thank you.
One question, I don't know if this was a factor in any of the analysis, would be age of either dependent children in terms of driving, either taking benefits earlier, or difference in ages of spouses, potentially pushing to take the benefit later if you had a young, younger spouse or something like that. Was any of that was that factored in as irrelevant?
So we didn't collect, it's an excellent question, and we didn't collect data explicitly on those two questions. We do collect data on whether or not people are married, and it doesn't seem to change. I think that is in the regression, or we've included it as one of the controls. It never comes out significant, interestingly enough. There's some beautiful work looking at the joint claiming problem, and of course that makes it even more complex. I mean, I sort of glossed over it by saying that claiming is this incredibly complex problem, and it is. And once you bring in joint claiming and different ages of spouses, it gets even messier. Questions about whose spouse had the higher income over their working life and what kind of benefits the spousal benefits come to. So we don't really dive deeply into that because it gets so complicated, and we just use marriage as a quick proxy for how much people might be thinking about some of those trade-offs. And it doesn't seem to really drive the results in any particular way. We have asked questions about whether people have children or don't have children. We haven't seen results there. And I think from a normative perspective, it's interesting to think about which direction having children could even go in, right? So one argument could be that having children gives you a safety net, that if you run out of money, they're there to perhaps take care of the parents. Another perspective is that people might feel that if they have children, they have they prefer to leave money behind, and they have bequest motives that are triggering some of their decision making. So we haven't found strong evidence for either one of those. We look at that even more in some of our annuity research and don't find there that it's driving preference for annuities, which is a case where you'd find that the bequest motives could be an even stronger driver.
So, Suzanne, I really like this paper, and I was excited to put it on the program. And I kind of want to say why and ask you a question related to that. So, this is one of the biggest options that the government designs, just in terms of the total amount of wealth that goes to people or is forfeited by people by their decision what to do. And it reminds me of the mortgage prepayment option, which is another one where it's just huge swings in wealth across households. So I want to ask in a different way, you're talking about, well, what do we counsel people to do behaviorally? And we take the option as being static. But if you were in charge of the Social Security system, you could also imagine changing the rules on that option. That option doesn't need to be as static as we treat it as. So, does your research suggest doing something like, imagine that instead of letting people claim at 62, only let them claim at 62 if they fill out a bunch of paperwork so that they have to really want to claim at 62, because that on average it's probably not in their best interest to claim that early. So I just wondered if you have any thoughts on, what could the government do, which they could do themselves to make the system work better for people.
A lovely question. It's like you're looking into my heart, and deepest desire is kind of a question. So I can tell you exactly what I would do to solve the psychological ownership piece, which is to provide something that I sometimes think of as almost a silver lining or an opportunity to grab a little bit of what people think is theirs early on. And so at 62, to provide the option to pull a little bit of money out of the system in exchange for lower benefits later, but not to actually trigger the full monthly check that Social Security would normally provide if you began claiming. So it gives people sort of a feeling that they've gotten something. And if they do, die tomorrow, they've at least gotten some of the money back, and they can leave it to their heirs or whatever. And the government hasn't kept everything, but the vast majority of the resource is held for that later claiming. And so it's almost like getting a little taste, but before really triggering the full-on stream of benefits that comes when people claim.
That's super interesting. I hope you're telling Steve Goss that.
Thanks.
Okay. I am looking at the clock. I think we probably need to end now, but I really appreciate it. It was a very interesting presentation. Thank you.
Thank you for having me.
Great. Thank you so much to Debbie for including me in this panel. She was a source of great wisdom and advice when I was doing my PhD here. And it's really wonderful to be with such esteemed panelists. So this is my job market paper from last year, Who Bears Flood Risk? Evidence from Mortgage Markets. It's part of my larger research agenda about what happens when banks and insurers meet in mortgage markets and the effect that climate change is having on that complex set of interconnections. So in terms of motivations, the big motivation for this paper came from the fact that flood risk has been increasing dramatically over time. You can see this on the right. This is worldwide data on number of floods and property damage caused by floods. In terms of which asset classes are most exposed to this risk, we know that real estate is really on the front lines. By some estimates, we have over $1 trillion of real estate in coastal areas, and we've had $500 billion of damages over the last decade in just the United States. So an important question when looking at some of those numbers is who's bearing this risk. So there are a lot of people that are involved, a lot of entities that are involved in real estate markets. In my paper, I focus in particular on three. So there are the households who choose to live in these high-risk areas. And then there are the lenders who originate mortgages in these areas. And the mortgage contract is really a risk-sharing contract between the households and the lenders. So it's important to understand sort of how that risk is distributed. And then there's the government. Now, the government is, of course, involved in real estate markets in a million ways. I'm going to focus here in particular on the government's role as a provider of flood insurance. Now, the key feature of this setting is that some of the mortgages can be insured against flood risk, but not all of it. And the reason for that is that these flood insurance contracts are incomplete. They're provided by the government and they're capped. So there's this residual uninsurable flood risk that has to be shared between the mortgage lender and the borrower. And so my paper is trying to understand kind of how that risk is distributed. So why does this matter? It matters for arguably two reasons. So the first is that, people in the Federal Reserve System, maybe some people in this room, have been thinking about whether there are large unpriced risks related to climate change in mortgage markets. So I have this quote here from Fed Governor Lael Brainerd, where she says it's vitally important to strengthen the US financial system to meet the challenge of climate change. The second reason this is important is that having accurate risk-based pricing has real effects in terms of determining who chooses to live where. So we know from the evidence on insurance that subsidized insurance can lead to overdevelopment and overmigration into high-risk areas. You can imagine that a mispricing of risk in mortgage markets could have similar effects on the spatial allocation of people. So what I do in my paper is the following. I produce a novel data set where I basically merged digitized current and historical flood maps with loan-level mortgage information. So this allows me to obtain loan-level classifications of flood risk. And then I focus my empirical analysis on trying to understand the causal effect of flood risk on mortgage contracts. So I look in particular at three key mortgage outcomes. I look at the mortgage's loan-to-value ratio at origination. I look at the interest rate of the mortgage. And then I look at the subsequent performance of the mortgage. So here, delinquency is going to be defined as whether the mortgage becomes delinquent by over 3 months within the first 5 years of origination. And I'm going to look at three different sources of variation in flood risk. So the first is going to be a purely descriptive exercise. The government creates boundaries of what they call flood zones, and I'm going to look at how mortgage contracts change sort of in versus out of the flood zones. But then I'm going to look in particular at two different sources. The first is going to exploit this incompleteness in insurance contracts that I mentioned, which is that there are these flood insurance coverage limits. And the third is going to look at the release of new flood maps that change the boundaries of flood zones, and then subsequently change people's expectations and beliefs about flood risk, and what happens to mortgage contracts after those boundaries change. So using these three sources of variation, I obtain sort of three key results. The first is that flood insurance is really important for mortgage markets, and that banks are indeed offloading a lot of flood risk to the government through these insurance contracts. But for those borrowers that cannot be completely insured using these contracts, I find that banks are rationing credit. So they're requiring higher down payments from those borrowers that are underinsured. And then finally, I'm finding that this rationing of credit has real effects, and it's changing the composition of borrowers who choose to live in high-risk areas. So it's pushing borrowers to be higher income and higher credit score. So it's leading to a sort of a slightly more optimal allocation of people to high-risk areas. So in terms of the data that I use, I combined a few different sources of data to obtain a lot of information at the mortgage level. So the first set of data I have is on mortgage contracts. This includes the mortgage's interest rate, the loan-to-value ratio, the maturity, the securitization status, and the subsequent performance of the mortgage. I also have information on borrower characteristics. This includes the borrower's credit score and the borrower's annual income at the time of origination. I also have information about the house, which primarily comes from Zillow Z-Tracks. So this is the property value, the size of the house, the address of the house, and information about local construction costs. And I'll explain in a couple slides why construction costs are important. And then lastly, I have information about flood risk. So this includes the flood zone at the time that the flood zone characterization at the time that the mortgage was originated, the effective date of each flood map, and also information about flood events and damages, so realized flood risk experiences, and then information about flood insurance take-up. So combining all this data, my final sample covers the state of Florida. I look at purchase mortgages for single-family homes, and my time period spans 2010 to 2016. So the first thing I do, having compiled this novel data set, is just produce some descriptive facts. How do mortgages differ in and out of flood zones? So what I'm doing here is I'm regressing my mortgage variables on an indicator for whether or not that mortgage is in a government-defined flood zone. And I kind of include or exclude various fixed effects and characteristics. So the fixed effects I consider a zip code year fixed effect. So this is looking at two borrowers in the same zip code. Mortgages were originated in the same year, but one is in a flood zone and one isn't. The borrower characteristics I consider are just sort of the key basic ones: the borrower's income, the credit score, and the property value, which we know is sort of the key characteristics in thinking about default risk. And so what you see here is that sort of on average, loan-to-value ratios are lower in flood zones. They're about 280 basis points lower. When you include the zip code year fixed effects, that number shrinks to a little bit under 200 basis points, but it's still big, it's still significant. When you include the borrower controls, that number shrinks further to about 100 basis points. And when you include sort of both the fixed effects and the controls, we get that on average loan-to-value ratios are about 80 basis points in flood zones. When you do the same exercise for interest rates, you see that on average, there's really no significant average difference in interest rates in and out of flood zones. And when you include sort of the full set of fixed effects and controls in the green bar, you see that that number is about 1 basis point. It is statistically significant, but economically, it's not very significant. And then when you look at delinquency, what you see is that on average, delinquency rates are in fact lower in flood zones. But that a lot of that is really driven by the borrower composition. So when you control for the income, credit score, and property value, that statistical negative number disappears, and you get what is actually a precisely estimated zero. So delinquency rates are basically the same in and out of flood zones. So what does this mean? This tells us that lenders are actually bearing less exposure to collateral risk in flood zones compared to out of flood zones because of the fact that people have higher equity in those areas. It's also telling us that lending in flood zones is actually not observably riskier than lending outside of flood zones, given what we're seeing in the precisely estimated zero in terms of delinquencies. But what it's not telling us is sort of why that's the case. So there are kind of two competing explanations for this. The first is sort of a supply side argument that lenders are really worried about flood risk. They're rationing credit, they're requiring higher down payments, and they're doing that in order to sort of reduce default incentives. So increasing borrower equity lowers the probability of negative equity and losses given default. So that's sort of a supply side interpretation of these results. But there's also a demand side interpretation, which is that banks are not really doing anything and they're just getting lucky because these flood zones are somehow attracting better quality borrowers. So why might that be? I'm looking at the state of Florida. A lot of flood zones in Florida, as there's, you know, coastal areas, beautiful beachfront properties that may just attract sort of higher quality borrowers. And so it may have nothing to do at all with, you know, credit rationing by banks. It may just be sort of a lucky accident. And so what we need is variation in flood risk that's not sort of correlated with these unobserved amenities that are associated with flood zones. So to obtain that type of variation, I look at two different identification strategies. The first is I'm going to exploit this flood insurance coverage limit. So I mentioned earlier, the government is the dominant provider of flood insurance, and these insurance contracts are capped at $250,000 in flood damages. So what that means is if you buy like a $300,000 house in a flood zone, part of that house is going to be uninsured against flood risk. There is very limited availability of top-up insurance in these markets. And so what I'm able to do is look at a cross-sectional differences design, which basically I'll explain in more detail, but allows me to kind of compare houses by how insured they are and whether they're in a flood zone or not. The second thing I'm going to do is I'm going to look at the release of new flood maps. So this is going to change the boundaries of the flood zones and arguably lead to new information about flood risk. So I can look at the same area before and after the release of the updated map and see what happens to mortgage contracts. So here's what I'm doing with the cross-sectional differences. So let's consider two borrowers, A and B. They both live in a flood zone. A buys a house that has a $100,000 value, and B buys a house that has a $300,000 value. So if I compare the loan-to-value ratio between A and B, I might find that the LTV for B is lower than A. But why is that the case? There's sort of two reasons, as we mentioned earlier. The first is that, you know, B has this uninsurable flood risk that A doesn't have, but it's also very likely that B has this unobserved wealth that A doesn't have. So I'm going to be kind of combining both of those effects when I look at this LTV difference. So the way I'm going to deal with that is I'm going to look at two additional borrowers, C and D, who live outside the flood zone. And they both are going to buy the houses with the same replacement value. And the key difference here between D and C is that D is likely wealthier than C. These guys both live outside the flood zone, so arguably there isn't this effect of flood risk. So it's purely going to be the effect of wealth. So when I compare these two sets of groups, I'm able to obtain the causal effect of flood risk. This requires two key identifying assumptions. That the first is that the wealth difference between A and B is the same as the wealth difference between C and D. This is a parallel trends assumption. And the second is that the effect of wealth on loan-to-value ratios is the same in and out of flood zones. So that's what I have to assume in order for this sort of empirical strategy to identify the effect of interest. The other key piece is that we actually need to understand when the house is underinsured. And so the relevant variable here is the replacement cost of the home. Insurers call this the replacement cost because it's how much it would cost to rebuild the exact same house in the event of a total loss event, if the house is totally destroyed. Now, this data, unfortunately, is not available. I can't just like download it, unfortunately, from standard sources. So what I do is I construct a proxy. And so the way I proxy replacement costs is I look at the size of the building. So I have that, it's in square feet. And then I obtain information about local construction costs per square feet. So multiplying those two numbers gives me a rough estimate of how much it would cost to rebuild a house of that size. So then I regress my mortgage outcomes on a dummy for whether or not that house is in a flood zone, and then an interaction term for being in a flood zone and for these different replacement cost categories. And so when I plot that, what you can see is that if you sort of look to the left of the red bar, that's for houses with less than $250,000 in replacement costs, you see basically no statistically significant differences in loan-to-value ratios in and out of flood zones. But once you get over that flood insurance coverage limit of $250K, you start to see a decrease in loan-to-value ratios in flood zones. And furthermore, that sort of difference is increasing in how much of the house is underinsured. So this is sort of exactly what you would expect to see in a world where lenders are worried about, uninsurable risk, and they're requiring down payments in order to offset some of that underinsurance. When you look at interest rates, you do see that on average, interest rates are higher in flood zones, but not significantly so, and that doesn't change around the cutoff. So this tells us that all the action in terms of the way banks are managing this risk is through the down payment side, not the pricing side. And then when you look at delinquency, so delinquency doesn't happen very much, so it's a noisy measure. So the error bars are big, but again, you see that there's really no economic or statistical difference in delinquency outcomes. So kind of taken together, this suggests that, you know, the LTV rationing is doing a fairly good job of stemming incentives to default. So the second identification strategy, which I mentioned earlier, is exploiting these remapping events. So the key here is that counties receive updated flood maps at different times. So FEMA comes in, they conduct a 5-year study of like elevation and local topological changes, and they release these new maps. Some counties receive a new map before other counties. And so what I've done here is I look at 3 sets of remapping events. Some counties are remapped in 2012, some are remapped in 2013, and some are remapped in 2014. And the idea here is that, you know, if we're worried about these coastal amenities and we want to kind of difference them out, we can look at the same area before and after the remapping. The amenities haven't changed. There was a beach there before, there's still a beach there. So what's changing really is the information that people have about risk coming from the maps. So the way I'm going to implement this is the following. So take this Orange County, and therefore zip codes in Orange County. And these are the flood zone boundaries under the old map. But now there's a new map. So the flood zone boundaries in zip codes A and B have expanded, and in C and D, they're the same. And so when we're thinking about information that's released, there's really no new information in C and D because the boundaries are exactly the same, but there is information about risk for zip codes A and B because now those boundaries have expanded. So presumably now lending in A and B would be considered riskier. There are a few different ways you could implement this. The way I'm going to do it is I'm going to do a zip code level analysis. So I'm going to take out the zip codes where no new information is released, and I'm going to look in the zip codes where that new information is released and is led to an expansion in the boundaries of the flood zones. And then this is staggered design. So I'm going to compare these counties that are remapped to counties that are not yet remapped. They get a map later. And so what happens when I do this event study, what we find is that after the remapping events, we see a significant decline in loan-to-value ratios. Up to 2 years after the remapping, we see almost a 2 percentage point decline in loan-to-value ratios. And again, when you look at interest rates, you really don't see anything happening on the pricing side. So again, this sort of different source of variation is confirming what we saw earlier, that banks are managing this risk using a rationing of credit approach rather than sort of changing their interest rates, changing the interest rates that they're requiring. And then the next piece is to look at the characteristics of the borrowers that are moving into these areas after these new maps are released. So when I do that, I found that in fact the average incomes and credit scores of these new borrowers are significantly higher than prior to the remappings. So you see that incomes are about 10% higher, and credit scores are about 5 to 10 points higher. So this is saying that an area got riskier, but it's leading to, or an area was perceived to be riskier, but the composition of people is sort of getting less risky. So this connects to the LTV results. It suggests that the fact that banks are rationing credit is leading to sort of this advantageous selection, and is pushing people who can afford to pay those higher down payments to live in the flood zones. So it's sort of leading to a better allocation of people to high risk areas. And there is another potential explanation, which is that the only people that are willing to live in a high risk area are people that know that they can self-insure or are not risk averse. And so to address that explanation, what I've done here is I've looked at the LTV results and I've split them up by high and low credit score and high and low income. And what we're seeing here is that the LTV reduction is really concentrated in the lower income and lower credit score groups. So again, this is kind of evidence against the idea that this is driven by borrower preferences. It really seems to be coming from the banks. And then if you look at delinquencies, what you see here is after the remapping events, on average, delinquency declines by about 1 percentage point. And so then the question is, lenders are rationing credit, and so do they still bear exposure to this flood risk with such a sort of small, maybe, adjustment? And the answer is actually no. I kind of argue that it's, in fact, the right level of adjustment. And the way I do that is the following back of the envelope calculation. So what is the risk that the lender bears? That's going to be the probability of uninsured losses over the life of the mortgage. That's sort of an unknowable number, but the way I'm going to proxy it is the following. So on average, we have about a 1% annual flood probability. That number comes from the fact that on average, there's a 1% probability of a flood insurance claim each year. And that's also how FEMA defines its flood zones. It's houses with at least a 1% probability, or you may have heard it as a 1 in 100 year flood event. And then I didn't show this chart, but I show in the paper that about 10% of floods cause property damage that exceed $250,000 in damages. And then the average mortgage duration in my sample is about 5 years. So taken together, that tells us that the sort of probability of uninsured losses over the life of the mortgage is about 50 basis points. In my remapping event study, I showed that a 2 percentage point LTV reduction leads to about a 1 percentage point reduction in delinquencies. So once you control for the compositional effect, the 1 percentage point LTV reduction would lead to approximately a 50 basis point reduction in delinquencies. So this back of the envelope, there are a lot of assumptions here. I'll highlight one in particular, but these two numbers are the same. It suggests that the 1 percentage point LTV reduction is sort of the right amount in order to compensate for the risk that they're bearing by lending in a flood zone. There are a lot of assumptions. The key one that I want to emphasize is that this assumes that lender recovery is the same in and out of flood zones. Recovery is not observable in the data. I would love to know exactly how much lenders lose in a default event. We don't have that data, so that's the assumption I have to make when doing this back of the envelope. So to conclude, I'm basically arguing that we have reason for optimism. Lenders seem to be doing a pretty good job of managing this risk. And that they are effectively offloading a lot of this risk to the government through the flood insurance program. But I want to take a second to talk about some policy implications. This flood insurance program is a government program. And one of the implications of my paper is that the biggest beneficiaries of this program are those fully insurable borrowers who are not getting credit rationed. But it's a huge program. It provides $1.3 trillion of coverage annually. And we sort of don't really know that much about what it's doing to incentives in the real estate market. So this is just one paper of many set of future papers I hope to write on thinking about this interaction between the government insurance program and real estate markets. And then on the systemic risk side, I argue that this combination of insurance along with credit rationing through LTVs seems to be doing a pretty good job of protecting the banking system. And that my results on the map seem to suggest that banks are actually effectively adapting to new information about risk. They kind of care about these flood maps and they're changing the contracts that they offer. And I also argue that this rationing of credit is helping to dampen some of the taxpayers' exposure to flood risk. There's a lot of other things in play that push people to live in high-risk areas, like disaster aid, for example, or subsidized insurance. This is a small effect going in the opposite direction. Thank you so much.
Okay, so I'll start off again. Most of your paper is about changes in flood risk and whether that results in changes in government exposure. I know this is not your topic, but I wonder, do you have any sense of the level question, which is flood risk priced appropriately on average? I don't know if you have the data that would help answer that.
It's a bit of a hard question to answer because the data that we have comes from an environment where a lot of the risk is underwritten by the government through the insurance programs and through disaster aid. So it's really hard to know sort of what the true level of risk is and kind of whether the pricing is appropriate, because we don't really have those market signals in this environment. But I argue that kind of in terms of what banks are directly exposed to and kind of what we see in the LTV side, I think it is properly priced. But again, that's in a world where a lot of government intervention.
Okay.
Yeah. Mhm.
Oh, go ahead.
So, Pari, yes, I still have a question, but it's not because the paper's changed as much as the world has changed. I know we corresponded a bit about banks, so I want to sort of ask about the banking side of it. Because in the delinquency case, the typical delinquency case, there's no damage to the collateral, but in the flood case, there's a lot of damage to the collateral. And if I thought about what the bank is concerned about, also the flood risk is a little more systemic than your typical default risk or delinquency and default risk. And so by pushing to higher income households, rather than just adjusting the interest rate, they are maybe working also on the extent to which you will recover the actual payment, even if the house value doesn't cover the loss. And so you're kind of shifting it to something. So I guess I'm wondering about the recourse-ness of this stuff and whether in an event of a flood that hit high income and high net worth households, banks would actually have a bunch of recourse that they would pursue.
Exactly. I think that's right. It's sort of outside the scope of the paper, but I agree that one of the reasons I think banks are doing this through the LTV margin rather than the rates margin is I think it leads to this advantageous selection, exactly like what you're saying. So it sort of screens for higher income people and improves.
Are
Yeah.
these in Florida where you're doing this? Is it recourse mostly?
I think it's recourse, but I haven't checked it unfortunately recently. Yeah, I think it is a recourse state though. Yeah. Mhm. Yeah. So it is confirmed it's recourse, yes.
I think we're, if there's a pressing question, we'll take one more, but we are out of time. There are box lunches outside. You have 9 minutes to bring them back, and we will get the fire going in the fireplace. And Professor Merton and Professor Lucas will join us for a fireside chat while you eat. So that's the plan.